Right, so we're going to do some ratio analysis work today. So we're on page 28 of your ratio analysis booklet. If you could turn to that, please. Okay, so ratio analysis is all about analysing the financial statements. It's using formulas to understand the profit and loss and the balance sheet a little bit more. Now, ratio analysis is usually used for comparison. That's a very important point. You use the ratios to compare how you did this year and last year, or to compare yourself with other companies. We'll talk about that a little bit more as we go through, but it's very important that you know that it's about comparison. And what we're going to do today is we're going to calculate some ratios, and we're going to basically look at how that affects a company and how they use those ratios to find out a bit more information. Now, we are going to calculate some, and essentially ratios are pointless on their own, but you could then use it to compare with previous years. Anyway, we'll work through some and see how we go. So as you'll have seen on the previous pages, you can sort of break ratios down into profitability, so a company's ability to turn its sales into profit, and into liquidity ratios as well, which are all to do with a company's ability to repay debt. So we're going to calculate some today. We'll talk about them as we go through and see how that helps us. Okay, so we're going to actually split the ratios down into the various parts of the financial statements where we find the information. So we're going to start off with the trading account on page 28, and we're going to calculate some. Now, each of these ratios that we look at, you've got to learn. You've got to know them off by heart. You won't be given them in the exam, so you do need to learn these formulas. All right, so we're going to have a little look at these. All right, so we're going to start off with gross profit margin. And that is gross profit divided by turnover times 100. So turnover is equal to sales. Turnover and sales means the same thing. All right, so we'll start off with gross profit, which in our trading account is 120,000. We're going to divide that by our turnover, which is our sales at 360,000. And we're going to times that by 100 to give ourselves a percentage. So if we stick that into our calculator, divided by 360,000 times by 100, we get 33.33 recurring percent. Now, what does that mean? That means that from our sales, from our turnover, 33% of those sales are going to turn into gross profit. Now, it means nothing on its own. It's just a figure. But if you can compare that with previous years, you can see whether you're doing better or worse. So if, for example, last year's gross profit margin was 25%, that means we're turning more of our sales into gross profit this year than we did do last year. Okay, so it's all about that comparison. All right, or you can compare between companies. So if Asda turns 33% of their sales into gross profit and Tesco turn 20% of their sales into gross profit, then Asda is obviously doing better because it's able to sell for more than it buys by a greater percentage. Okay. Markup is the next one. It's very similar to margin, but this time it's gross profit over cost of sales times 100. All right. So again, our gross profit is 120,000. We divide that by our cost of sales, which is 240,000. You can see on the trading account there. And again, multiply it by 100 to get a percentage. So 120 divided by 240 times by 100 gives us 50%. So what does that one mean? That means we're adding 50% profit to the cost of our goods. All right, so 50% of our cost of sales is added back on to find our sales price, and that gives us a 50% profit. So £120,000 difference between our cost of sales and our sales. So basically, if you buy for £5, you're selling it for £7.50. You've added £2.50 on, which is 50% of your cost of sales. All right. Again, you'd have to use that as a comparison. So we've got 50%. Again, if we're Asda and we've got 50%, if we buy something for £10, we're selling it for £15, which means we can add £5 on, or 50% of our purchase price. Now, if Tesco's is 75%, that means they're doing better than us. You want the higher, the better. So that means that they're able to add more value to their purchases than we are. Okay, so the next one is rate of stock turnover. Now, this is like an efficiency ratio. It tells you how many times in the year do you completely replenish your stock. So how many times during the year did you buy stock, completely sell it out, and then have to buy it again? Now, this will be different for every company. For example, a florist is going to have a rate of stock turnover of 365. It means that it's going to have to change its stock every single day. Flowers die, or any perishable good will go out of date. It will not be able to be sold anymore. So you would have to change your stock every day, whereas a car dealership might have a rate of stock turnover of around 8, which means it completely sells out of its stock 8 times a year and has to buy in new stock. And it tells us how efficiently we're using our stock. All right. So we're going to just do this one and we'll talk about it a little bit more. So our cost of sales divided by average stock. So our cost of sales is £240,000. Now, average stock is opening stock plus closing divided by 2. All right, so here we've got 16,200 plus 15,800 as our closing stock. I'm sorry, my table's a bit wobbly. We divide that by 2, so what have we got there? 16,200 plus 15,800 divided by 2. I should know the answer, it's 16,000. So opening plus closing divided by 2 to give us 16,000. So 240,000 divided by 16,000. So 240,000 divided by 16. Oops. Divided by, no, stupid calculator. To give us 15. Now, the answer for this one is going to be in the number of times. It is important that you recognise within the ratios, whether it's a percentage, whether it's times, etc. So that means that we change our stock 15 times during the year. So we buy our stock, we completely sell out, and then we have to rebuy it again 15 times during the year. Now, you want that number to be as high as possible. You don't want to be holding too much stock. So if it was, for example, 10 times the previous year, then you're more efficient this year because you're not having to hold stock for that long. Remember, if you hold stock, you need a warehouse. And if you've got a warehouse, that's got costs attached to it. Okay, so the rate of stock turnover, that's a really commonly assessed one. So it is worth learning that one inside out and back to front. Okay, right, moving on. We're going to look at the profit and loss account now. So the first one is net profit margin. Now, net profit margin is the amount of your sales that turn into net profit. Now, you may see this as profit for the year rather than net profit, or even operating profit. It depends on what the company's looking for. We're just going to use net profit for now because it's commonly assessed. Okay, so remember from the previous page, our turnover was 360,000. Now our net profit is 24,000. So 360,000 being our turnover, which is 24,000 for the net profit. And we're going to times it by 100 again. So 24,000 divided by 360 times by 100 gives me 6.67. Just do it to 2 decimal places. Have I done that right? Just check. I have. Always worth checking. Yeah, 6.67. I think it's, never mind, 6.67, 6.6 recurring. 2 decimal places, as I say. So that means that for every £1 of sales that we make 6.67 pence worth of profit in terms of net profit. Now that's interesting, and we should use that and look at that in comparison with our gross profit margin, which, if you remember, was 33%. So what we can say there is we can use those to see how well we're controlling our overheads, how much of our gross profit is then turned into net profit because of our overheads. So what have we got? 33 and 6.6. So 33.33 minus 6.67. We've got about 26.6% of our sales are being paid out in terms of overheads. Again, you'd use that to compare with previous years. There are certain things you can't control, like inflationary measures and increases to the minimum wage and stuff like that. But you should be trying to control your overheads so as much of your gross profit as possible is turned into net profit. So you'd look at that as a year-on-year trend to see if you're controlling your overheads better year on year. Okay, so overheads in relation to turnover. Our total overheads are 96,000. Our turnover is still 360,000. Okay, so 96,000 divided by 360,000, and we're timesing it by 100. I forgot to write that down. Times by 100. And we get what the answer we said before, the 26.66%. So 26.66% of all of our sales are being paid out for overheads or for expenses. Overheads and expenses are the same thing. Now you can then subdivide that into each of the individual expenses to see which expense is causing you the most trouble, so to speak, or how much of your turnover you're paying out for each of those individual expenses. So you can do those. It's very simple. So you do the admin expenses is 12,000 divided by the turnover of 360,000 times by 100. 18,000 for the rent and rates divided by the 360 times 100. Wages and salaries is 48,000 divided by, sorry, I'm wobbling all over the place, 360,000 times by 100. And depreciation is 18,000 divided by 360,000 times by 100. So you could do that for each one. Then I'll allow you to calculate those yourselves if you want. I'll just pause it and then do it and see if you got the same as me. So we've got 3.33%. 5%, so the top one and the bottom one are both going to be 5%, and then 48,000 times by 360,000 times by, 48,000 divided by, 48,000 divided by, I know this is terrible for a video, I should edit this out, but it's, why? All right, so you can see there for each of our expenses, we can see how much of our sales we're having to pay out in terms of expenses. And that can then inform which of your expenses is having the biggest effect on your net profit. So here, our wages and salaries is 13.33% of our turnover. That could then be looked at to be controlled, or you can compare it with previous years. 13.33% might be reasonable. If you might compare it to last year and see it was 17, 18%, and you say, oh, brilliant, we've actually managed to control our wages and salaries, so we're not paying out as much in comparison with the amount of sales we've made, okay? So they're the profit and loss ones, and the trading account ones. We're going to have a look at some ratios for the balance sheet now. We're going to start off with return on capital employed. Okay. So there's quite a lot of information on page 30. Make sure you read that through. We'll talk about them as we go through this now. We're going to start off with return on capital employed. All right, so we've got a different company this time, so different figures. And everything in the balance sheet here is in the thousands. That's important for you to know. So for example, where we've got our stock at 217 there, that's actually 217,000. All right, so just make sure that you're aware of that for when you're doing some of your ratios. Otherwise, they'll come out dead weird. All right. So we're going to look at return on capital employed. So net profit before tax and interest, which we know from our limited company booklet, is operating profit. So you can change the formula to call operating profit if you want. I just called it net profit before tax and interest because I stole it out of the textbook. So there you go. All right, so operating profit of 210,000 according to the information in the book, divided by capital employed at the start of the year. Now, capital employed is the total of your long-term liabilities and your capital section. They call it creditors falling due after more than 1 year on some limited company balance sheets, and your capital and reserves, as we know from our limited company booklet, is our equity section for a limited company. So you can do this for a sole trader, you can do it for a limited company, it doesn't matter, just be sure you're aware of what bit goes where. All right, so we use capital employed at the start of the year. Now, if you don't have the information at the start of the year, you can use the ones at the end of the year, but it doesn't actually work as well or in a way that you'd want it to. So capital employed is the money you've borrowed and the amount you've invested plus your reserves, okay? So it's the money available to the company during the year, which is why we use the one at the start of the year. The capital employed at the start of the year. Because what this ratio is going to tell us is how much profit did we make with the money available, or what percentage of the money available did we turn into profit. All right. So how well did we use that money available to us during the year? So here we've got a return on capital employed of 210,000. We've got total long-term liabilities of 300,000. That's the net asset figure, the 1,400 there, so you can ignore that. So it's this 300,000 there plus the total capital and reserves, which again is 1,400. Remember that'd be 1.4 million because that's in thousands. So you've got 210,000 divided by 300,000 plus the 1.4 million to give us 1.7 million. All right. And we're going to multiply that by 100. So 210,000 divided by 1.7 million gives us, no, that's wrong. 210,000 divided by 1.7 million times by 100. 12.35%, because it's times by 100. So I'll just do that again just to check so I don't get emails saying, Pete, you did it wrong. Which is fine. You're allowed to do that. I don't get hurt at all. I do sometimes. Cry at home, on my own. Times by 100. Yeah, 12.35%. Let's round it again to 2 decimal places. So that means of the money available to us during the year, we returned 12.35% of that back as profit, which would be excellent. Again, you'd have to use it as a comparison though. So if it's 12.35% this year, that sounds quite good. You know, for every £1 invested, you're bringing back 12.35p into the company in terms of profit. But if last year it was 15%, then it's gone down. Now, you can use this as an investor. You can look at their return on capital employed to see what would you get back from that company if you put your money in, or what profit would the company make for your extra investment. It's a very common calculation made by people who are looking at how efficient companies are at using the money invested in them. All right. So again, it's a pretty important one that we see that one quite a lot in exams. Return on capital employed. So 12.35% there. Okay, we're going to quickly move on. We're going to start looking at some ratios that are more to do with liquidity. All right, so we're going to have a little look at these. Page 31. See how we get on, eh? All right, so net current asset ratio, sometimes known as the current ratio, sometimes known as the working capital ratio. Several names for it. Sadly, you've got to learn all of them. So this one is current assets divided by current liabilities. Now, current assets are those assets that we're going to turn into cash within the next year, and current liabilities are those debts that we've got to pay within the next year as well. So it's the money available compared with the debt that we've got within a year. So are we going to be able to pay our debts off within a year? So again, we're going to be using the information from the previous page. I'm just going to turn my book. You're not going to be able to see it, but it's just so I don't have to keep flipping back and forth. So our current assets are, let's have a quick look. Current assets total are 380,000 from the previous page in the second column there. So 380,000 is our current assets. Our current liabilities are 210,000. All right. So if we did 380,000 divided by 210,000, we get not 17,000. That's wrong. 1.8. Now, with these ratios, what we do is we put that to 1. All right, so it's a true ratio. The others are percentages. This is a true ratio. So the current ratio is shown to 1. So that means in this example that we've got 1.8 assets, or 1.8 current assets for every £1 of liability. Now that gives us an indication that we're able to repay our debt. Now, anything above 1 to 1 is good because it means you can pay off those debts. If it's like 0.9 to 1, 0.8 to 1, something like that, that's a sign that you're in trouble, that you don't have enough current assets to pay off your current liabilities. So you'd have to think of something like getting a loan or selling an asset, a fixed asset, in order to repay your current liabilities. So you want that to be over 1 to 1, at least. If it's over 2 to 1, that's also a bad sign because it means you've got too many current assets compared to your current liabilities. You can easily repay your debt and you'll have spare cash. Now, you shouldn't actually have spare cash, believe it or not, or not a great deal of spare cash, because it means you're not expanding, you're not using your money efficiently to grow your company. Okay, next one is the liquid capital ratio. Now, this is exactly the same as the previous one, but this time we remove inventory or stock from our current assets. So we had £380,000 worth of current assets. We've got stock of 217,000. And our current liabilities are still 210. Now, we already know that this is going to be less than 1 to 1. So let's have a quick look. So 380,000 minus 217,000 gives us 163,000. Divide that by 210,000 and we've got 0.78 to 1. So this means that once stock has been removed from our current assets, we've only got available liquidity or available monies of 78p for every £1 of debt. Now, we remove stock from this ratio simply because it's the hardest asset to turn into cash. If you could already sell your stock and turn it into cash, why haven't you done so already? So we remove it from our current assets to give a better indication of the available monies, or to give us an indication of what would happen if we were unable to sell our stock. It's actually more commonly used than the current ratio in exam sittings because students forget that. So try not to. Okay, we're going to move on to a couple more. We've got our debtor collection period. Obviously, this can also be called the trade receivables collection period. You might see it called debtor days. You might see it called trade receivable days. Lots of different names for it. I've called it debtor collection period, but just know that a debtor and a trade receivable are the same thing. So let's have a little look at this. And so debtors divided by credit sales times 365. So we're going to do the calculation and I'll explain what it means. So I'm just going to look back at the balance sheet on the previous page, and our debtors are 114,000. Underneath the balance sheet on the previous page, it tells you your total credit sales were 1.4 million. I'm going to multiply that by 365, which means it's going to give us an answer in number of days. So if I just stick that into my calculator, 114,000 divided by 1.4 million times by 365, 29.72. So again, do it to 2 decimal places. Some people will round it up, so that would be 30. So that means that on average, it takes us 29.72 days to get our money back from our debtors. All right, so that's what you do. Get our money back from our debtors. 29.72 days after the day we've sold to them. That's interesting enough on its own, I suppose, but we're going to use the creditor payment period and make a comparison between the two numbers. So I'm going to do the same thing, but this time putting creditors and purchases in. So our creditors are 69,000. Or trade payables, again, could be called trade payable days. and our purchases were 930,000. Multiply that by 365. So if we go 69,000 divided by 930,000, not 93,000, 930,000 times by 365, we've got 27.08 days. So that is a bad thing, really, because if we're buying on credit, remember I only use credit sales and credit purchases. Sorry, I forgot to mention that. Basically, what that means is that if we were to purchase and to sell on the very same day, so for example, were we to sell on the 1st of January and purchase on the 1st of January, all right, so we purchase the goods from our supplier on the 1st of January, we're going to have to pay them back on the 27th of January, all right? And we sold the goods as well on the 1st of January, but we don't receive the money back from the debtors until the 29th, almost the 30th of January. So that means that we're using our own money to buy our goods, which could cause us liquidity problems up here, our ability to repay debt. We want our debtors to pay us for the stock before we have to pay our creditors. That way, we're using the money received from the debtors to pay for our stock. All right, so we're basically not using our own money, are we? We're just getting stock, getting the money in, and then having that money available to pay our creditors. Whereas in this one, in this example here, we would have had to have money in the bank already to pay for the stock, because our debtors aren't going to pay us until 2 days later. Now, in an ideal world, you could kind of set up a business with no money, buy the stock on the first day, sell it on the first day, and have the money received from your debtors before you have to pay your creditors. That would be an ideal situation. All right. So you want to make sure that your creditor payment period is longer than your debtor payment period. Or debtor collection period, sorry. That would allow you to not have to use your own money. Okay, right, last one for today is the gearing ratio. Again, very, very common, this one, and it comes into lots of different questions, so you must know this. So gearing is all to do with a company's risk, really. It's all to do with risk. It's a very important word. Write it down. Risk. It's fixed return finance over all sources of finance times by 100. Some people call it debt over capital employed times 100. I prefer that one, debt over capital employed, all right? Because what this one's going to tell us is of the money available to us, how much of that money do we have to pay back? All right, so we're going to use an example. I'll talk you through it as we do the example again. Now, it does say here that fixed return finance or debt is preference shares plus debentures plus long-term loans. Now, preference shares are no longer in your specification. I've just left it there because it's in past papers, so if you do come across it. So preference shares are shares that you repay eventually. And they receive a dividend first. Again, not on this spec, so I wouldn't worry about it too much. So if I look at the previous page on the balance sheet, let's see what we've got. So preference shares are actually on there at 200,000. So 200,000. We've got debentures and long-term loans. There's no long-term loans, but there is a debenture at 300,000. So we've got a total of 500,000 there, divided by capital employed. Now remember that capital employed is long-term liabilities plus capital and reserves. All right. I know some of you are going to complain about my handwriting again. I'm really sorry. It just means I'm super intelligent. Okay, so our long-term liabilities are 300,000 and our capital and reserves is 1.4 million. So again, capital employed 1.7 million. Oops. And we're going to times that by 100. So I'm going to put that in. So 500,000 divided by 1.7 million times by 100. 29.41%. Okay, so that means that of our capital employed, 29.41% of it is borrowed. We are therefore at risk of things like interest rates. If interest rates rise, then we may have to pay more back in interest. Okay, so it's an indication of risk. The higher the number, the more risk you're at. The lower the number, the less risk you're at. You don't want to really go above 50%. A company above 50% gearing is called highly geared or a high geared company. And that means it is at serious risk from interest payments, and they will affect profit and also liquidity, because that's money going out of the company every single year. So this company looks in a relatively good position, but again, it's to do with comparison. Some companies are exceptionally highly geared, and that's just the way they function. There's lots of stories in the news at the moment about companies struggling due to loans having to be repaid and stuff like that. And then there's other companies that are successful, and you'll see that they take out millions of pounds worth of loans every year, and they function absolutely fine. So it's about comparison between previous years and comparison between companies within the same industry. Okay, that's a very long video. That's it for today. I will speak to you soon. Bye bye.